Well, hello. My name is Justin Williams. I'm with the Justin Time Realty Group here at Keller Williams Realty in Vestavia, Alabama. And we're excited to have you as a client here with us. We're really honored to be able to work with you and to serve you throughout this transaction. And our goal is to make sure that you have the ultimate real estate experience while you're in this transaction with us. So today I really would like to just go through the process of what it means in order to buy your house. How do you buy it? What happens along the way? What are the costs that are associated with this transaction? So you can make sure that you're fully educated and fully equipped with all the information that's needed to have, again, the best real estate purchasing experience that you've had before. So again, we want to go ahead and just kind of jump into the transaction process. But before we do, I just want to give you a brief introduction of who I am. So again, like I said, I'm Justin Williams with the Justin Time Realty Group. I'm originally from a little small place called Burnt Corn, Alabama. So I know you don't think that's a real place, but it is. So country boy at heart. So if you've ever heard of the book To Kill a Mockingbird in the Monroeville area, that's originally where I'm from. So about an hour below Montgomery and about an hour above Mobile. So again, a country boy at heart. But UAB brought me to Birmingham. So I came to Birmingham in 2006 to go to UAB, and I finished in 2010. And from there, I've stayed in Birmingham, and now I've been in real estate for a few years. And it's been a really blessed career. Had an opportunity to work with a wide variety of clients. Some people are upgrading homes, some people are downsizing, some people are purchasing their first home, some people are relocating in and out of the city. So it really gives us a great opportunity to see what goes on in different areas of Birmingham, as well as different price points. So again, my goal is to make sure that you're extremely educated through this process so you can know exactly what's going on every step of the way. So let's go ahead and jump in. So the initial step is to find a real estate agent. So we're here. We've already taken care of that part. I'm extremely excited and honored to be able to serve you throughout this transaction. And from there, today, we're having what we call our buyer's consultation. So we're sitting down, we're analyzing your needs, we're finding out what you're looking for, your time frame, your budget, all those different details when it comes to finding out the exact idea of what you're looking for. As well as we're gonna go through a detailed explanation of the process. So really showing you what's gonna happen along the way and what your costs are gonna be associated throughout that time frame. So we're spending this time together to make sure that you have all that information. So after we finish today, our next step is to go ahead and take you through the pre-approval process. So what does it mean to be pre-approved? So the pre-approval process is a really important part of the process because this lets you know financially what are you responsible for, down payment wise, monthly payment, closing costs, all these different terms that you hear about that people are really intrigued about. So just to give you a quick understanding of how the pre-approval process works, the loan officer that we're going to connect you with, they look for two things. They look for at least a 600 to 620 credit score. And again, that may differ just depending on what a person's situation is, but those are like bare minimums. Everything above that is really helpful because that allows us to qualify for extra programs and incentives and things like that maybe someone with a lower score would not qualify for. So they're primarily going to look at that credit score. They're going to look at your work experience to see where do you work and if you have any stability with your job. And then they're most importantly going to look at something called your debt to income ratio. So what is DTI? Like you hear DTI, what does DTI mean? Again, that's your debt to income ratio. So in layman terms, what that means is they look at how much money do you have coming in each month versus how much money do you spend each month on debts. And when we talk about debts, we're talking about specific types of debts. So car payment, student loan payment, mortgage payments, credit card payments, any debt consolidation payments. Those are the types of debts that they're looking for. So they're looking at Mr. and Mrs. Customer, this is how much money you have coming in each month, and this is how much money you're spending on these particular debts each month. So they take that equation. They say, hey, you have this coming in, you have this going out. So based on that equation, this is how much house you qualify for. So people ask, well, how can I qualify for more house? One of two ways. Either you can increase your income or you can decrease your debt. Those are going to be the main two ways that you're going to be able to qualify for a higher purchase price on the house that you want to buy. Okay, so they're going to look at your debt to income ratio, and then they're going to check your credit score, and primarily during that pre-approval process, they're also going to find out what type of loan do you qualify for, because that's going to let you know what your monthly payment is going to look like. So these are just some of the basic loan options that they have. So there are several different types of loans, several different types of programs that are available, first-time home buyers, first responders, all that type of stuff. But these are your basic products that most every lender has. So you have your FHA loan. So a FHA loan is basically a loan that's insured by the government. So if you default on that loan, the government bails the bank out, okay? That loan generally has the lowest down payment, which is 3.5%. So if you're looking at a $150,000 house, $200,000 house, ideally your down payment is going to be somewhere around $5,000 to $7,000 on those particular purchase prices. And again, that loan will take you all the way up to about $300,000 or so, okay? So on that particular loan, a lot of first-time home buyers tend to go with that loan because the house has to be in the best condition possible in order for the bank to approve that type of loan. So we're talking no chipping paint, no rotted wood, no loose handrails. None of those things that you see in most of your fixer-upper homes will allow that house to qualify for this type of loan. So basically you're able to move right in and live in this property. Again, you have a 3.5% down payment on that particular loan, which is called a FHA loan. Your next option would possibly be a conventional loan. So a conventional loan is a loan that's not insured by the government, okay? So on that particular loan, they generally are looking for a little higher credit score, and they're also asking generally for a little bit more down, okay? So your down payment is generally anywhere between 5 and 20% on a conventional loan. There are some exceptions to the rule, especially for first-time home buyers. Sometimes they do have a 3% conventional product for specific cases, okay? But on a conventional loan, you have a lot more flexibility with that particular type of loan. So you can buy a fixer-upper type home, an investment property, you can buy a second home. You have all different types of flexibility with the conventional loan. So again, the requirements are a little bit higher because they give you a lot more flexibility on that particular type of loan. So let's say, for instance, a person can actually make the monthly payment, but they don't have any down payment money saved. Well, there are options for those individuals as well. So one of those options is a program that's called Alabama Housing, okay? So remember, we just talked about an FHA loan that has a 3.5% down payment. So Alabama Housing is a third-party organization that will come and help you with that 3.5% down payment. They will say, hey, instead of you making the full 3.5% down payment, we will loan you the extra $3,000, or excuse me, the extra 3% for that particular loan, okay? So now you as the consumer, or you as the purchaser, is only responsible for the extra 0.5%. So again, let me make sure I go back and explain that the best way possible. Again, on the FHA loan, you're responsible for a 3.5% down payment. Alabama Housing is a third-party organization that will come in and cover your 3%, and you as the consumer is only responsible for the 0.5%, okay? So in real life scenario, when we were just talking about anywhere from a $5,000 down payment to about a $7,500 down payment, that $5,000 down payment just went down to $1,000, okay? And that $7,500 down payment just went down roughly to about $2,000 or so, okay? So it's significantly less that you would be responsible for putting down. And again, that is a great option for individuals who can make the monthly payment, but they may not have down payment money saved. Lastly, you have a loan that's called you have a loan that's called USDA, okay? So USDA is for all of your rural areas. So here in our vicinity, a lot of the areas that would qualify for USDA would be majority of your rural areas. So if we were going west, we're talking about past McCalla. If we were going south, we're talking about below Calera or in Calera and below. If we were going east, we're talking about Pinson and further on east. If we were going north, we're talking about more about the Kimberly Warrior on further north of that area. So that particular loan with USDA, it's 100% financing. So again, that means you really don't have a down payment, okay? So USDA is loaning you the entire 100% of that purchase. So again, if you're buying a $200,000 house, you're borrowing the entire $200,000 for the bank. There is no down payment that you will be responsible for, okay? So all those are great options. Again, when we talked about the pre-approval process, we find out how much house we qualify for. We find out what our monthly payment is for those particular loans. We find out what type of loan that we're able to get. And this is an educational piece for all of my clients, okay? If you're in a position to make a down payment, let's do so. It's only gonna benefit you in the short term and in the long term of purchasing your home. And the reason I say that is for one of three reasons, okay? So if you make a down payment on your home, generally your monthly payment is gonna be less, okay? Instead of you borrowing the entire $200,000 from the bank, if you made that 3.5% down payment that we talked about, then generally now you're borrowing a lot less. You're only borrowing 96.5% of that purchase price. So again, in layman's terms, if you're buying a $200,000 house, you make that $7,500 down payment, then now you're really gonna be mostly in the lower 190s or so as far as what you're borrowing from the actual bank, okay? So again, your monthly payment is gonna be a little bit less at 190 or so than it would be at 200,000, okay? Second reason is gonna be if you make a down payment, then you're gonna have more equity in your home. So what is equity? Equity is the amount of what your home is worth versus what you owe on it, okay? So we're gonna go back to our scenario. If your house is really worth 200,000, but you only owe 150 to the bank, okay? Now you have $50,000 worth of equity in that particular property. And that equity can be used for several things. Let's say, for instance, you wanna go and invest in real estate, okay? You can take that equity out of your home and go purchase an investment property. You can use that equity if you're gonna start your own business. If someone falls on hard time, they lose their job, whatever the case may be, you can borrow that equity out of your home in order to use those funds for other things that you want to use them for. So equity is very beneficial. Equity is great, okay? That's a good thing to have. And then lastly, when it's time to sell that home, because I know you're gonna call me again when it's time for us to sell that home and help you either upgrade or downsize, okay? So when it's time for us to sell that home, generally you're gonna make more money on the sale of that home as well because, again, you owe less money back to the mortgage company or to the bank, okay? So making a down payment is very beneficial, and that down payment money can come from several different places. It can come from a retirement account, so 401k, IRA, mutual funds, all those different types of things. It can be gifted to you, so maybe from a family member, a parent, someone like that. And it can also come from grant funds, okay? So again, the pre-approval process is really, really, really important because that's your foundation when it comes to purchasing this home financially, okay? The last thing that you're gonna find out during that pre-approval process is about closing costs. So closing costs are the actual cost for the bank and for this transaction to happen, okay? So you have origination fees and application fees and transaction fees and all these different things that are included in your closing costs. Now, in our market, there are times when we can get the seller to pay that closing costs. Now, in case we're in a situation where we're in multiple offers, we fall in love with the home, and there are multiple people that are trying to purchase that home, if the numbers are extremely tight and you guys say, I absolutely have to have this house, then we need to have some backup options for closing costs. We need to have some allocated funds set aside just in case we run into a situation where we're gonna be in a position where we need to pay our own closing costs in order for us to be able to secure this home for you. All right, so we just covered pre-approval process. Extremely important because that is our green light to continue to move forward with this thing, all right? So we never run into a red light, we may run into a yellow light, which means we need to pause and kind of reposition how we're gonna approach things. But again, that pre-approval process, once we get the green light from the mortgage person, then we're able to take off and start finding your dream home. So what happens from there? So we get the pre-approval process taken care of. We know how much we're responsible for on the monthly payment. We know what our numbers look like. We know how much our down payment is going to be. So we take off when we start finding a home. So we're going to have a conversation about what does that home look like for you? What are the requirements? How many bedrooms are you looking for? How many bathrooms are you looking for? What size home do you need? Do you like open concept, and how large does the home need to be? Are we looking for a basement? What are the specifics on the inside of the home? As well as what does the neighborhood need to look like? What do we need to be close to? What are our amenities? All of those things that everybody likes to talk about when it comes to purchasing a home, okay? And we're gonna take that criteria and we're gonna start sending you listings according to that criteria. And we're gonna be very specific to that criteria. We're gonna be we're gonna lean to that criteria very heavily, because this is gonna allow us to stay efficient throughout this transaction. So basically, we don't have to kind of run out and look at 100 homes, because we know what we're looking for. And that allows us to be able to move faster during this transaction, because now we're not looking at properties that don't meet your criteria or things that you're not even interested in, okay? So we're gonna start sending you that criteria. You will be able to rate those properties, and based on rating those properties, that will also give us a better idea of what it means as far as the type of home that you're looking for, so we can be diligent in identifying that home as quickly as possible. So we're gonna go out, we're gonna take a look at the properties. We also have showing agents that are a part of our organization that will be able to assist you. So we wanna make sure that our clients are able to view a property whenever it meets their availability, okay? So we have people on the team that will be able to assist you with taking a look at that home. So once you look at that home, you've taken a look at everything, you know exactly like, hey, guys, this is the house that we wanna purchase. From there, we're gonna come back together and we're gonna write an offer on that property. So the offer consists of several different components. You have your purchase price, so what are we offering as far as price? What are our terms? Mr. or Mrs. Seller, we want you to pay for this, and we're willing to pay for this, and hey, we want you all to do that, and we're willing to do this. All those terms that we're negotiating throughout that offer and that contract period. Also in the offer, we talked about closing costs. So are we gonna ask the seller to pay for closing costs? Are we in a position where we need to pay for closing costs? How does all that look, okay? As well as our estimated closing date. So when I say estimated, closing does not always happen exactly on that day for several reasons. And we'll talk about those reasons in just a second. But that's basically what's included in that offer. So we send everything over to the sellers. The sellers take a look at that offer, them and their agent, they review everything, and then they determine, are there things that we want to change about this offer? If so, then they will send us their changes, and we will look at those changes, and then we will go through again to determine if there are any changes that we want to make. So this is just the counter offer process. So we're just counter offering back and forth between us and the sellers and their representation. And from there, once we come to all the terms of being agreed, so you all have agreed to everything, they have agreed to everything, we have all signatures, then we actually have an official accepted contract. So yay, we're excited at this point. We're overjoyed that we've been able to put that property under contract for you. And now it's time to go ahead and start doing the heavy lifting of getting everything closed out for you. So once we get that property accepted, we get that contract accepted, there are gonna be some costs that are gonna happen along the way. So we're gonna talk about those costs and the things that are happening along the way that are involved with those costs. So once that contract is accepted, the very first piece of money that we will spend in this transaction will be your earnest money, okay? So earnest money is an advancement towards your down payment. So what does that mean? That means like, hey, we're putting a little money in the pot up front that's showing that we're actively looking to purchase this property, and this is an actual advancement towards my down payment. So it's similar to making a deposit on an apartment, okay? So we're gonna put that money in an escrow account. And when that money sits in the escrow account, these are the terms that are centered around earnest money. So if we back out of the contract for reasons that are not in the contract, let's say, for instance, we get to the end and we just completely change our mind. Everybody has done their part. The sellers have done their part. The mortgage people have done their part. And we just get to the end and we completely change our mind. Then the seller does have right to keep that money because we did not uphold to our portion and our agreement in the contract, which stated that if everything went how it's supposed to, then we would proceed with the purchase of that home. Let's say, for instance, we get into the transaction and we just cannot come to terms. Like we get an inspection and we can't come to terms on what's going to be fixed in that property. For some reason, the appraisal comes back short. For some reason, we have some termite issues. Could be a host of things. God forbid you lose your job, and we definitely hope that doesn't happen. But let's say, for instance, something crazy like that happened during the transaction. Then we're able to, as long as we stay within our time frames, and we'll talk about those, we're able to request those funds back and back out of that contract. Now, once you actually close on the house, so everything goes according to plan, no issues, the transaction is smooth like we planned for it to be, then that earnest money that you have put down up front when you put a contract on that property goes towards your down payment. So a little bit earlier, we were tossing around some numbers about the down payment. So if you're putting down a certain amount of earnest money, that goes towards that down payment that you're responsible for at closing, okay? So the earnest money is the very first piece of money that you pay in the transaction. Now, after we go under contract on your home, the very first thing that we want to do is have a home inspection. So the home inspection is extremely important for you as a buyer. Alabama is what we call a caveat emptor state, which really means a buyer beware state. So it is the buyer's responsibility to know the condition of the property of what you're purchasing. And how do we do that? We hire a licensed home inspector to come in and inspect this property on our behalf. So that home inspector looks at everything: the roof, the HVAC, the plumbing, the electrical, the foundation, the windows, you name it. They turn it inside out and they look at everything. And then that inspector will ask you, if you're able to be present towards the end of his or her inspection, so they can show you the items that they have found throughout their inspection of that home. They're also going to send us a very detailed report, including photos, descriptions, and all of those things. So we have an actual report showing us everything that inspector found. We take that report and we go through that report and we determine what are issues to you, what are you all willing to deal with, what are things that may be deferred maintenance, what are things that we're uncomfortable with, and we will go through that report in detail to determine what things we're going to ask the seller to fix and what things we're not going to ask the seller to fix, okay? So again, as we're navigating between that process, that's where we're actually going through and negotiating any repairs that we see on that inspection report. So for your home inspection, the home inspection is generally going to cost you between $300 and $400. And that determines, or that really depends on the size of the home, or if there is a crawl space, or a couple other things that could depend on. But generally, your cost for a home inspection is going to be somewhere between $300 and $400, okay? So after we get the inspection done, there's a portion in the middle there that actually takes about 30 to 45 days from the time that you get a contract on a home to the time that you close. So you're going to be working with your mortgage professional. The mortgage professional is they've already checked your credit during that pre-approval stage when we talked about that, but they're going to continue to monitor your credit throughout the transaction. So these are like your thou shall nots when it comes to buying a house. Thou shall not make any large purchases, okay? So we have a lot of people who will go out and they'll make some large purchases, like a car, for instance, okay? So if you buy a car, you might want to get ready to sleep in it because you probably won't get your house. When you buy a car, you're adding an extreme amount of debt to your debt to income ratio that we talked about earlier that wasn't there before, okay? So do not buy a car in the middle of this transaction. Also, thou shalt not save, thou shalt not make any large cash deposits in your account. So all money has to be traceable. So we joke and say, if you hit the lottery, just pay cash for your house, or either put the money under the mattress until you close, okay? So we have some people who have, they may work on the side. They may have jobs that they don't actually get paid for with a normal check, or they don't have to file a W-2 for that job or something like that. So all money has to be traceable. All money has to have a paper trail, okay? So again, any large cash deposits, we need to be aware of those. Also, thou shalt not save 20% at belt. Okay, so what do I mean? Like, don't go apply for any new credit cards. Don't go and save 20% at belt. They say, hey, I need you to sign up for this belt card, this Macy's card. We have people who will go and put furniture on layaway at Rooms to Go, or add it to their account, go buy a refrigerator for their home, different things like that, okay? Please be cautious with that type of stuff, because again, if you're adding these things to a credit account, now you're affecting that debt to income ratio. And generally, if you're opening these accounts, you're also affecting your credit score as well, okay? So we kind of joke with people, but we're also serious when we say, just eat bread and water till you buy your house. And after that, you can ball out all you want to. You can do whatever you want to, okay? So they're gonna check your credit. Now, through that mortgage process, they're also gonna ask you for a list of documents. So they're gonna ask you for your tax returns, your bank statements, your check stubs, and W-2s. And this is how they verify your income. They're gonna send all that information to the underwriter. So the underwriter's job is to really pick everything apart, okay? Underwriting is probably gonna be the most frustrating part of this transaction. And rightly so. The underwriter's job is to secure the money and to make sure that the borrower is qualified for this particular loan. So they're gonna go in, they're gonna verify your tax returns, they're gonna make sure that you work where you say you work and you make the amount of money that you say that you make. They're gonna ask you possibly for explanations of things, and they're gonna ask you for more documentation. So again, sometimes people get a little frustrated during underwriting, but don't be. It's all necessary. We just like to go ahead and kind of give you a heads up ahead of time. So after you finish underwriting, they're gonna order an appraisal on your house. So the appraisal is where the bank is gonna send their own person out to make sure that everything is in order with this particular property. So a little bit earlier, we talked about no rotted wood, no loose handrails, no chipping paint, those type things. The bank is gonna send their person out, and he does an appraisal, okay? So he's also gonna go out, he or she is also gonna go out and make sure the house is worth what we've agreed to pay for it. Now, for the bank to send their person out to do this appraisal, generally is gonna cost between $400 and $500 for an appraisal, okay? From there, once we get that appraisal done, then you also have the availability to do what we call a survey on your property. So a survey tells you where your property line begins and ends. So if you want to put up a fence in your backyard, you're buying a ton of land and you're not really sure what's yours and what's your neighbor's, then from there, that's where the survey really benefits you, because it tells you where your property line begins and ends. And it also will tell you if there are any easements or anything like that on your property. So for a survey, it's generally going to cost you between $300 and $400, and that money is paid directly to the surveyor. So surveys are not required, but they're optional. They're not required, but they are highly, highly recommended. And lastly, you're going to be checking on your homeowner's insurance. So you're making sure that you're able to get the coverage for your property and for your home that you deem necessary. So all of that stuff is going on with the mortgage person during that time period. And while we're handling our business, the sellers are going to be working on their business. So their job is going to be to conduct a title search. So that means they're making sure that there are no liens against this property. They're making sure that everything is clear. So if you're like me, you have a really common name, Justin Williams. There are probably a bunch of us out there. So there could be something on this particular property that may not be associated with me, this Justin Williams, but with another Justin Williams that they've just accidentally put on the wrong person's name. Okay, we have that happen a ton. So again, they're making sure that they're clearing up any liens. So if they got some work done on the property, they never paid the contractor, there's a mechanic lien on the property, they have to clear that up prior to selling us the property. Homeowners association liens, hospital liens, tax liens, you name it, people can put liens on your house for different things like that, okay? But those liens have to be cleared in order for us to be able to finalize this purchase of that property and for them to be able to turn over the deed to the property to us. They're also working on any repairs that we've negotiated a little bit earlier during the transaction. And at closing, they will provide us with title insurance to ensure us that we have a clear title. So again, all of that stuff that's happening that we just talked about is the reason that it generally takes 30 to 45 days to actually close on your home. But once all that has been completed, the bank says everybody has done their part, everything is good to go, all the boxes have been checked, then the bank gives us what we call a clear to close, and from there, we're able to come back and close on your home. So at closing, you're gonna sign a whole bunch of papers. You are who you say you are. If you don't pay, you don't stay, those type of things. We're gonna take some photos, laugh, smile, have a great time, and then you're gonna receive the keys to your home. Now, there are a couple things that we also get for our clients throughout this transaction that we always wanna make sure that's taken care of for our clients. So first of all, we generally request a home warranty. So a home warranty is basically like having a maintenance man on call. So if you have any issues in your particular home, you can call the home warranty company and they will send someone out to repair those items or replace those items for you as long as they're covered under your plan. So we're asking the seller to pay for that plan for you for your first year as a courtesy of moving into that home. Now there is a trade call fee for the home warranty person to come out, and generally it's between $75 and $100 depending on your plan. But as long as it's covered under the plan, then they're able to take care of whatever else is needed to be done with that particular issue. Lastly, we also are getting what's called a termite bond and wood infestation report done on that property. So a termite bond is where we're sending a person out from the termite company to make sure that this house has no termites. So they do a detailed inspection to make sure the property has no termites. And from there, they will do a treatment. We're asking the seller to pay for that particular service for you as well for your first year. And therefore, they will continue to come out and spray and treat for you during your first year. With your home warranty, as well as your termite bond, if you would like to keep those services, then you will be responsible for picking up the cost of those services going forward. Okay? So I know that was a lot of information at one time. I know you may have some questions centered around that. We hope we did a phenomenal job with at least trying to introduce you to those particular things and explain them to you the best way that we feel that will help you understand what's happening throughout the transaction. So what we tell people is generally it's best to have about $1,500 to $2,000 set aside just for those things that we talked about between earnest money, survey, inspections, and all of those types of things. It's best to have about $1,500 to $2,000 set aside just for those items. Lastly, people ask a ton of questions generally about foreclosures and short sale properties. So if you see any of these, please go ahead and contact us so we can answer these questions for you. Generally with the foreclosure, you're probably not going to get any repairs on that foreclosure from the actual owner, which may be the government, the bank, or whoever owns that property, okay? So foreclosures, you'll be able to possibly get a good price on them, but you're going to be responsible for the repairs of that particular home, which can be done through a renovation loan or can be done out of pocket or whatever the case may be. So foreclosures are a really case-by-case scenario. So again, if you see one that you're really interested in, make sure that you contact us so we can get the specific information on that. Short sales are very similar. The seller and the bank are working together now to sell that home instead of going through foreclosure. So there are going to be a lot of parameters around that. It's also an oxymoron. You think short sale means it's going to happen really fast. It doesn't. Generally, short sales take a while because, again, you're traveling through several channels in order to get answers to questions and things negotiated on a short sale. So again, I hope that information was helpful to you. It's really important. And again, we're really excited to be able to serve you throughout this transaction. I look forward to speaking with you directly soon so we can continue to move forward throughout this process. We're excited to work with you. You're just in time to purchase your home. Have a great day.